You might be thinking to get a 15-year fixed to save yourself on some interest over the course of the time that you're going to have your loan. In the basic idea of this, yes, you would save a lot of money. For instance, if you're doing a 30-year loan at 6%, over 30 years, you would have paid $1.79,280,000. So that's a lot to pay off the loan plus the interest. So people are considering to do a 15-year to save on the interest of that loan, but I want to talk about a couple of things that come up where you may regret that decision. So the idea here is that you pay lower interest, and most of the time a 15-year fixed has a lower interest rate than a 30-year fixed. Actually, today is April 25th, 2023 when I'm doing this video, and 15-year mortgages are actually pricing out in a lot of cases higher than a 30-year fix. So to save on the interest rate in this scenario right now, in the times that we are, it's not really accomplishing that. However, the time factor is definitely a saver. So if you were going to take that 30-year loan and do it as a 15-year loan instead, you'd save over $300,000 by paying it in 15 years versus 30, which is great. This is a very good thing to do with your money. But you don't have to have a 15-year loan to do the same thing. Rather than doing that, it would probably be best in some cases, and I'll go over the cases in a moment, if you just do a 30-year and then make the monthly payment based on what a 15-year loan would be, and you'll end up with the same end result, saving the $300,000. But if you do a 30-year loan, there's a few benefits that you might not have considered at the time that you closed your loan. So one is your payment is going to be quite a bit higher than the 30-year because you're paying it off in such a accelerated time. I did a calculation, that same loan amount, same interest rate, so $500,000 at 6% over 15 years would be a monthly payment of $42.19 versus a 30-year at $29.98. So if you're able to do it, go ahead and make the extra payments. But by taking a 30-year loan, there's a few benefits that you might not consider. So I want to go over a few things to think about. One, if down the road you ever think about wanting to buy a vacation home, or maybe you want to buy an investment property, or maybe you want to qualify for a new home purchase before you sell your current home, that monthly payment for the 15-year fixed is going to be used in your debt to income ratio calculation. But if you could have the 30-year and do it, and then the minimum payment on your credit report would be calculated for the 30-year payment. So you're only going to be having the $29.98 in your budget versus the $42.19. It makes a big difference in what you can qualify for. So I've had clients come to me to want to buy a vacation home or an investment property, or qualify for their next purchase before they sell their old, but I have to use that existing payment in their debt to income ratio. And there's been a few people that were a little bit sad that they had that 15-year payment that I had to factor in. So consider that you might not know what you're going to buy in the future right now. Your life might change and you might make that decision later. Other thing is life happens. So you might have a loss of a job or loss of income that you need to have that option of the lower payment calculated on the 30-year loan. You might have a family or health expense that comes out of nowhere. These are things that we don't really plan for because as things are going well, you just don't really think about some of the things that can come up. So you want to have that lower payment to fall back on in your budget. It just gives a little bit more flexibility, and you can still make the payment at the 15-year payment calculation and still save the same amount of interest Just do it on your own, and don't have the bank force you to do it. So hopefully this helps in your decision. If you have any questions on this, want me to run some scenarios for you, please reach out.